Yeah. So what I have done is I have started to clean up the session notes. I will clean them up progressively even more. But what I am doing, you will notice, is that in order to reduce the clutter, I am actually taking some stuff which we have written in the session notes in the class and converted it into a separate doc file, like this entire discussion on this. These files are all in your notes, but I have put hyperlinks here so that you can directly go. We know that at this point of time we were discussing this topic, and so the further discussion on this topic, you just click this hyperlink and open that, and so this will reduce clutter on your main session notes file, because this is like a running track of what we are discussing in each session. So this is what I'm trying to do now. I've cleaned it up already quite a bit, and I will clean it up even further, and I will transfer them into notes, and you can get the hyperlink here. So it'll be easier. I think it'll be easier to monitor, to sort of follow for you guys. So what you have to do is see all this stuff that I'm doing. What I'm actually doing is I don't need to do any of this for myself because I know everything. So what I do here is when I look at these notes, I put myself in the shoes of a student, and I ask myself, I mean, is this making sense? Is there a logical flow? And so I try to make it easy to understand, and I make it, I try to arrange the topics in such a way that the logic is flowing smoothly. So your duty as a student is to, but obviously I can't, do a perfect job of reading of putting myself in your shoes. So your job as a student is to give me further suggestions as to, what you think can be done to improve the notes to make it easier for students to understand. So if you have any such ideas, you let me know, and then I will try to incorporate them. If I think it's going to work, then I will incorporate. So you have to give me suggestions, anything that, and plus anything that you don't understand in the notes, it's your duty to tell me that I didn't understand this particular sentence in this note. That you have to tell me, otherwise I can't. I'll just assume that you understood. All right. So where we were, so all these blue links, these are all hyperlinks, and then you have to click those links. So where we were is, and once again, I'll just repeat. Let me also go to, since we are on the topic of notes. So now I'm looking at the notes master spreadsheet, which is like your course website, where all the links that you need for the project are going to be included. So you have, basically we've got three levels, two levels at least of notes. One is the ideal sequence that we would follow, which is given here, but because of the lack of time and we have to complete the project, we are not able to follow this, but you guys should try to read this eventually. But more important than that, I've told you guys to read the absolute bare minimum readings for the project. Okay, this is the stuff that you have to do first, otherwise you will not understand what I'm saying. So a lot of the things, so the entire course is focused very much around the project, and we like look at the decision problems you're facing inside the project, and trying to build up the theoretical foundations that you need to solve. Let me admit Soria here. We're trying to establish the theoretical foundations that you need to solve the problems that arise in the course of doing the project. For that, so therefore you go to this list. You go to this list, and out of this list, you pick out the stuff I've given here, and make sure you read them and understand them. Then if you don't, then you ask me questions. This stuff you need to know in order to follow what I'm saying. Okay, so that's your first kind of level, or first two levels: ideal sequence of notes, time pressure based, bare minimum readings for the project, and then I've created a separate file where I'm trying to put in all the. This is not an exhaustive list. Okay, so you make sure you follow the session tracker. I'm trying to make this exhaustive. I will add other notes here, but mainly right now we are now focused on these decision problems. Okay, so what I've done is based on the discussions I've had, I've tried to create one document for each of the decision problems, and all the discussions we have on these decision problems I've put into these documents. These documents are all in your notes. You can just launch them from this website, whatever suits you. Okay. So this is how you should be proceeding, and this is how we are also proceeding. We are going, first what we did was we listed out all the decision problems, and then we gave you some kind of a broad idea about each of them, and later on we'll come back for greater discussions. But initially what we are now doing is, in a slightly haphazard way, not necessarily in the sequence, but we are now addressing each of these DPs and trying to figure out how do we solve these, trying to figure out how we solve these DPs. Okay, so we have given you certain ideas. So this is how we are going, all right? So if you get confused, this is a guideline you should follow, and you should read the notes like in this kind of, with this kind of broad approach. All right, so now what we have done in that, as part of that plan, what we have done is we have already had some discussion about this, okay? So I'm not going to go into that further. As you go, when you go there, you'll see, when you go to this page, you'll see I have referred to this, this page, and we had this discussion, right? We have discussed on the session board in your calc file. I'm now looking at the IPM Summer 20 calc file, where we keep any calculations or other notes on a course-wide, on a daily basis, on a session basis. And so this is the part I've referred to in that note. Okay, and we already had this discussion, so I'm not going to spend more time on this. Now we've already done this. Now we came to this, then we came to this discussion of this problem. How do we decide the buy-sell bias? And of course, the other thing you could say is buy or sell or wait, don't do anything. I've not put that in just to make it a little simpler, okay? So if you can't decide this, then you just wait, and then you revisit the problem. So if you look at a particular chart, say if we take our FCX as our example, right? We look at FCX, and we don't really have a clear view. We are not very sure as to whether we want to buy or sell. So in that case, we just leave it, and then we come back to this problem, and then you keep addressing these questions repeatedly. You may do it several times a day. You may do it at least once a day, or you may do it once a week, whatever be the frequency in a general sense. But of course, in your project, you should actually do it maybe at least once a day, if not more frequently, because your project is very short term. Okay, so buy, sell, wait. Wait, we can leave out the wait part, because you look at it and you can't figure out whether you want to buy or to sell. Then you just wait, let it be, and then you come back again and ask yourself once again the same question: should I buy or should I sell? All right. So this is what we are doing. Now we came to this problem, and we were discussing this particular problem. So in that discussion, we came to this in your summer calc file, IPM calc file. We came to the sheet called DP4. So if you actually look at your DP4, right? So there are two preface notes. I'll go through these a little bit. Preface notes 1 and 2. 1 we have already discussed. Okay, I just put it here because it's related to this idea. Preface 2 is based largely on the question that Harsh asked at the end of the previous class. Okay, so I have put in some detailed notes on that. I'll explain that briefly. And then we are going through that, and then we are talking about solving DP4, which is the actual topic of this particular note here, right? Solving DP4. Maybe we can put a hold over here. All right. Okay, and so here I've referred to this diagram. So if you actually, the way these hyperlinks work, if you directly click this, it will actually take you directly into this page, into this sheet, the DP4 sheet. Otherwise, you go there. And this is the diagram that we looked at, and we said that there are two broad approaches to solving this problem. Okay, this particular problem, or to buy or to sell. What should be my bias, buying or selling? So there are two broad approaches, and what we are calling, one is called value agnostic. Okay, it's essentially TA. We'll come to that later. And we were discussing this paradigm. Okay, so this is a long recap. I've spent about 10 minutes doing a recap just to make sure that you have the context right and you understand where we are. Okay, and so we had this discussion, and we said that if you look at the notes, it says omitting AFV for now. Okay, AFV is slightly complicated, so we are going to leave it out, although AFV also belongs in this particular sphere. Okay, so we're leaving it aside for the moment. We're only discussing what I called FPV, which is forecast-based valuation. Yeah, it's written over here, forecast-based valuation, FPV. And it's also essentially, I've called it FA. FA is fundamental analysis. All right, so this is what fundamental analysis is really all about. And this stuff you're already familiar with because you have used most of the fair value models that we use in this in this branch of the tree. And you've already used you've already used these models, all right? So I'll just, we are discussing further what is the theoretical framework for solving this problem. Solving the problem. The problem is whether to buy or to sell, okay? Whether to have a buying or selling bias. And two approaches, this one, and then under this again, two further approaches, and we are discussing this. And in this, we discuss the fair value models that we use, all right? So, and we have explained to you how the framework works. What is the basic application of the framework? Very obvious, actually, but still we need to be very clear about how it works. Is that you use a model like this, okay? You use a model like what you have used, your stocks, Gordon growth model or something like that, okay? And you derive what is called a fair value, which is the question of what is the asset actually worth, okay? This is the fair value estimate. You derive this estimate by using one of these models, like a Gordon growth model kind of model. And then the way the framework works is you use this kind of a generic asset valuation model, and then you come up with a fair value estimate, okay, which is subjective. Very important to remember, this is subjective. And so it has really not much, you should not rely too much on this, because it's very subjective and it may well be wrong, and different people have different estimates. So then if the logic, as Harsh explained in the previous class, is that if fair value is higher than market price, okay, you look at this and you find, let's say we use a long-term chart, you look at Freeport, and you find that the fair value is $20 and the current price is $14. And so in this case, the market price is below the fair value. So in this case, what you do is you buy, that is fair value is higher than market price, you buy. If fair value is lower than market price, you sell, okay? So this is a basic framework. So maybe I should put this in bold, right? The basic operation of the framework, very simple, but you should still understand where all this belongs, okay? So just to make sure you have the context, which means when you were doing all your project NPV and Gordon growth model in your FM1, etc., FM1, FM2, the framework that you are operating in is basically this. So remember that your basic approach in this is you're comparing your fair value estimate, these models, NPV and all these things. NPV, when I'm talking about NPV, I mean leaving out the C0 term, okay, leaving out the cost of the project. Leave out that term, the rest of the equation, okay, is the rest of the equation on the right-hand side is essentially the fair value estimate of the fair value of the project, okay? And then you compare it to the cost of the project. So essentially, the thinking that you were applying, which you may not have been aware of when you were using these models, okay, these are all the same, by the way, Gordon growth model, fair value of NPV, the basic structure is the same as I showed you. What you're essentially saying is the market doesn't really know much. I don't trust the market's judgment. I think that the fair value of the asset that I'm looking at, in this case, say FCX, I think that the fair value of the asset, what the asset is actually worth or should be worth, is something different from what the market believes. So when you're in this box, actually, you have to understand that this implies a fundamental lack of belief in the accuracy of the market's estimates. Okay, the market has an estimate, say 1490 for FCX. So you fundamentally distrust the market's pricing of the asset. Okay, you have to understand the mindset. That's the mentality. Okay, that you fundamentally distrust the market's basically, you don't have much regard for the market's assessment. And that's why you want to do your own assessment. And therefore, you go into this kind of a model. You project the future returns from the asset. That is, how much will FCX earn, or what kind of dividends will it give you. Okay, those are basically the same. If you use dividends, at the end of the day, Eventually, all the earnings have to be paid out as dividends in the last period. So now you do this kind of you apply this framework, and you arrive at your own subjective assessment of the fair value of the project. Okay, so this is basically, so the reason I'm going through this over and over again is you need to understand the philosophical approach and the mindset that you had when you were using these kind of NPV, Gordon growth models. You are trying to find out fair value, and then you will compare it to the market price, and then accordingly take this decision. Okay, and so sell. In this case, you can sell in your current project, but some people in some of the investment funds have what is called a long only strategy, which means they are not allowed to be net short. They're not allowed to do what we call short selling in the previous class towards the end, where we had a discussion with Harsh after the class was over, short selling. So some funds have only a long only strategy. Many mutual funds, most mutual funds actually, most traditional mutual funds have this kind of a strategy. So in that case, what they would do is, if they did this analysis of FCX and they found that the fair value of FCX is actually only $10, they did their model analysis, putting in the Gordon growth model, etc., applying it to the GGM. I'm just going to call it GGM. And apply the GGM to FCX, and they find that the fair value is only $10 and the market is now $14. So the based on this, the fair value is lower than the market price. So ordinarily they would sell, but in this case, since their fund has a long only mandate, remember this is part of the investor mandate. Okay, when you look at your DP 1 to 3, what at this part of does not address this the long or short is not addressed over here, but as part of the broader investor mandate which affects these decisions, they will also have a condition on whether you can go both long and short, or you can go only long. Okay, so therefore what they do is, if you're a long only fund, then you look at this and you find fair value is lower than market price, so you ideally you would sell, but you can't sell because your fund is long only. So you at least you refrain from, you don't buy. Okay, so that's the way the model is, the framework is used. So another correction, I just want to sort of correct kind of a slight qualification that to the terms we used in the last class. Now, because of this difference between, it's very important to maintain the difference between this value and price when we are using this lingo. Okay. Okay. One more thing, guys. I just want to make it very clear. Now, as you can see in this project, we have a lot of technical terms to understand. Okay. So, and we don't have that much time. So I am going through this whole, most of the course I'll be going through in a very lecture tutorial kind of method. Okay. So it is not an interactive thing like, oh, Suresh, what do you think? Abha, what do you think? Give me your input. And then I put this typical case study method, because that will take too much time. So I can't afford to do that. So you have to understand that, you can't afford to get bored, because you have chosen finance. And I'm telling you, based on my experience, what you need to know if you want to be a serious finance student. So it is your job to listen attentively. And I'm trying to now quickly run through the concepts. Okay. So if you feel that, I'm getting bored, he's just giving a lecture, then you can't afford to get bored. You don't have that option. Okay. So you have to pay attention. And if you don't understand, you have to ask me. So this is the way it's going to go. So just wanted to give you that clarification in case you get bored, because we have so much material to cover that if I go through the case study method, it will just take too much time and we will not be able to cover the ground. Okay. Is everyone clear about that? Okay. I hope you guys are clear about that. Okay.
Yes, sir.
Yeah. So you please pay attention. Make sure that's, as I said, it's not my job to make finance interesting to you. You should already be interested in finance. My job is to select the course material, arrange the notes in a very logical sequence, and most importantly, explain all the concepts to you, 100 times if required, until you understand it. That's my job. Okay, it's not to make finance interesting to you. So by doing all this interactive session and this. Okay, so coming back to this, I got a little bit lost because I just wanted to give that clarification about pedagogy, because I can see I'm just giving a lecture. So I was a little worried about that. Right. So what were we talking about? Yeah. So I was another clarification I want to issue here. We have to be very careful about how we use these terms, value and price. Okay. Now, as I told you, value is subjective and price is objective. Okay. I hope everybody understand. Objective means what was the closing price of FCX? That's objective, because you can't say that, no, I think it was $18. It's not $18. It was 14.90, period. There's no discussion of this, because this is the fact. But when it comes to what is the fair value of FCX, now all of you 37 people can have 37 different views on it. Okay. And you could all be right. I mean, in the sense that there's no way to really prove that one person is right and the other person is wrong. Very difficult to do. So that's what is meant by subjective. And you have different estimates. Okay, so that's why we have to be very careful about the use of these terms. So that's why I said I'm just issuing one correction. So Harsh had used the word market value in the last class. I think the expression market value should only be used in this context, in this manner, to mean this. So if you are holding, say, 1 ounce of gold and the price of gold is $1,300, then the market value of your gold position is $1,300 times 1 unit of gold. Okay, so if you are holding 10 units, then 1,300 into 10 units. So we use the word market value to refer to the market value of a position, essentially. Okay, so of a position consists of the position size and times the price at which the position was acquired, and then later on you keep marking to market and using the market price. The market value of the position, you can keep on updating it with the market price. So that's how the word market value should be used. Otherwise, you should use the word value and price very carefully. Now, what will happen is you will find that people in the industry are not that particular. Okay, so when I'm teaching you, I will be teaching you at 2 levels. So I will tell you what the industry terminology is, but I will also tell you why that in certain cases that industry terminology may not be theoretically correct. So you have to understand it as, because you're MBA students, you're not just a layman. Okay, so therefore you have to understand many of these terms at 2 levels. One, what is the industry convention for using it? And second, in case that industry convention is wrong, what is the theoretically correct way of using those terms? So even when you go into industry, you may not be able to correct people and change their habits, but still you need to be clear and in your own mind so that your concepts are clear. Okay, so one of the things you'll find that in the industry, you will find, I'm typing in my session, I'm now directly typing in this, okay, not in the session file, because I have already linked in the session file, as you will see for today's session. We are already discussing the DP4 solution. So this hyperlink is already there, all right? It takes you to this file. So in order not to clutter this board, I am actually writing all this stuff in DP4, because these are all discussions based on focused around DP4. Now, industry practice, okay, is to use terms like this: market, all right, market, stock. The market is overvalued, the stock is overvalued. They might say FCX is overvalued. Some people are now saying Tesla is overvalued, whatever. Okay, this is what they'll say: FCX is overvalued, Tesla is overvalued, the dollar is overvalued. Okay, they may look at dollar yen and say the dollar is overvalued, undervalued, overvalued, undervalued. Now, this is actually not the theoretically correct term. Actually, what they say when they say this, okay, what they actually mean is, because the market does not value anything. Okay, we have to be consistent about this. Okay, because what they are actually doing is they are looking at this. When they say FCX is overvalued, what they actually mean is that maybe their estimate of the fair value is $10. So they look at the market price and they see the market price is 14.90, and then you say FCX is overvalued. That's what people will say. Okay, if their estimate is $10 and the market price is 14.90, they'll say FCX is overvalued. Okay, but this is actually not. This is what industry practices. This is how people talk. Okay, and the same thing applies in currencies and other areas. Now, in this case, what you have to understand, when people say that market is overvalued, undervalued, what they actually mean is that market stock, let me just copy this and then change it. So I want you to understand this. The reason I'm telling you this is also mainly to make you understand the theoretically correct way, so you understand the different correct way to talk about it. Okay? So maybe there's some background noise here, just ignore it. Okay. What they actually mean is the market stock dollar is overpriced. Okay, overpriced or underpriced. Okay, so overpriced or overpriced or underpriced, priced relative to my estimate. Okay, my estimate of its fair value. Okay, it means the asset's fair value, whatever the asset is. You could be talking about FCX, you could be talking about dollar, yen, okay, whatever it is. Okay, so understand this. So when people say that FCX is overvalued, when their estimate of fair value is 10, this language is actually not correct. What they should have said is that because the market does not value anything, the market prices things. Okay, the market allows the interaction of supply and demand. Okay, as you're exchanging the two assets, in this case US dollars and FCX common stock, you're exchanging the two assets. There's constant interplay of supply and demand, and the market is constantly pricing and repricing the base asset. Okay, you should have understood now. In this market, the base asset is FCX. I'll give you some quick other examples. In if we take this, all right, Australian dollar in this currency market here, the base asset is Australian dollars. Okay, so the market is pricing Australian dollars. So if I say the Australian dollar is overvalued, actually what I mean is, in this case, this is Australian dollar because this stuff here, 1 unit of Australian dollar is constantly being priced. These are all explained in your notes, okay? You have to make sure you read all the notes so that you understand what I'm saying in the class. In this case, this is priced as, this market works on the basis of Australian dollar being the base asset. So here, 1 unit of one Australian dollar is how many US dollars? Well, 55 cents at this point of time. Here it was 55, then 60 cents, and 75. Now it's getting towards 75 cents. At one point, it used to be almost 80 cents, okay, in Jan of 2018. Then it fell all the way here. So now if I say the Australian dollar is overvalued, okay, we just call it Aussie. So if we say Aussie is overvalued, in that case, what we mean is that, let's say my estimate of fair value of Aussie dollar is 60 US cents. This is my estimate of the fair value based on a similar kind of calculation using this kind of a model, okay, fair value model. Then what I'm actually saying, I will say Aussie is overvalued because the market is trading at around 73. What do I actually mean? That the market price of the Aussie is too high relative to my estimate of fair value, which is here, okay? So that's why I'm saying that when people say that market is overvalued, undervalued, it's actually sloppy language, but this is how people talk, okay? What they actually mean, or what they should actually have said, is that whatever the market, stock, dollar, etc., whatever they're referring to is overpriced or underpriced, okay? And over or under means it's always relative to something, obviously, right? If you're saying overpriced, underpriced, it has to always be relative to something. Relative to what? Relative to my estimate of its fair value. That whoever's making this statement, he should have actually made this kind of statement. This is what they actually mean. So I hope you understand. This is a bit of a long discussion, but it's necessary to make sure that your thinking is very clear about value versus price. Okay, and the market doesn't price anything. The market doesn't value anything. The market only prices things. Okay. So if you read your notes, you will see there is something called price discovery, which I have explained, which is nothing but a fancy term for the market activity and constantly resetting the price, constantly setting and resetting the price as supply and demand is interacting. and the market price is being constantly set and reset in the market, that is called the price discovery process. Okay, so the market prices things, it does not value things. So you should never say that the market is overvalued, but when you get into industry, you may have to say it. But in your brain, you should understand that this is what you should actually be saying. Okay, so a long discussion on that. But okay, so this is one clarification on the value versus price element. Okay, another thing that I just want to issue as a clarification, if you see your preface one, I have already explained earlier, I'll just put it here because of where it belongs. Okay, now preface two relates to the question that Harsh was asking the other day about short selling. Okay, so I've put in certain elements. You can read this later on. If you have any doubts, you can ask me, but I'll just briefly explain. So if you see your earlier note, in your early notes in the first few chapters, which I have given essentially as essential reading for the project also, that this is how we understand financial markets. All right. So there are always going to be two assets. Remember that. Any transaction, there are always going to be two assets. Even if you can't see it, obviously it's not apparent from the price quotation. But there's always going to be two assets. And there is this question of funding. Okay. And anything that you buy has to be funded, and then the proceeds of the sale has to be reinvested, has to be invested. Okay. So this idea is there. And so this relates to this idea, just trying to what we're trying to explain here in this case, in this particular preface, the second preface is that the idea of short selling. Okay, so you have to also think about the idea of funding. That you have to always think about how are you going to finance something. Because if let's say if I want to buy say 100 shares of FCX, or let's go back to FCX. Right, so if I want to buy 100 shares of FCX, so that's 1490 into 100. I have to come up with that amount of money. So I need those dollars. So where will I get the dollars? Either I already have the dollars, okay, in which case it's in the form of equity. This money belongs to me. It's my savings. Or I borrow money to fund that purchase, okay? So it has to be funded. So you should think of it from the balance sheet point of view, that there's always a debt equity funding that has to be put in place. Debt equity or some kind of hybrid between debt and equity, preference shares and things like that. So this concept of the balance sheet has to always be there in your mind, that there is a funding involved. Okay? And the other idea that we are trying to introduce in this preface, which is what Harsh was asking about, that, remember another definition that we have given you is that financial markets are, every transaction is a contract to exchange assets, okay? And usually one of those assets will be a currency, because we are trading most of the things, whether it's copper or crude oil or, another currency, or common stock of Microsoft or whatever, or debt issued by Tesla, bonds issued by Tesla. Whatever you're trading, usually trading it against some other currency, some currency. So usually the other asset is a currency. So, it's a contract to exchange assets, okay? And you don't have to own the asset that you're contracting to sell. This is the idea here of short selling. So all you need to know, another thing that you'll come to know when you do your preliminary readings, is the distinction between the transaction date and the settlement dates, okay? So first of all, we define a transaction in a financial market as a contract to exchange assets. Okay, and remember from your contract law, if you enter into a contract, if I enter into a contract with Rajat to sell him a plot of land 9 months from today, that means that the transaction, once we finalize the contract today, we are already bound. I am bound to sell him the plot of land, and he is bound to pay me the money at the rate that we agree in the contract. But the cash payment for the land and the transfer of the land will happen only 9 months from today. But we become bound from today itself, because today is the transaction date. Once we finalize the contract, once there's offer and acceptance, and then the contract is finalized, but the delivery does not have to happen for 9 months, because that's what we have said is the delivery date on the contract. So therefore, Rajat is not required to come up with the money for that land right now, okay? And I'm also not required to have that land today. I may actually buy that piece of land from somebody else later on. As long as I can buy it and deliver it on that particular settlement date, which is 9 months from today, I'm fine. So it is not necessary. So the first departure from conventional thinking that we have.
Sir,
Yeah.
Sachin this side.
Yeah.
Sir, what is derivative then? In this, the contract is also called derivative, I guess.
No, derivatives are just, see, derivative we are coming to come to later, but essentially I'll just tell you, if we go back to our framework of asset classes, markets and instruments.
But then in derivative, there is also a contract between two parties.
Yeah, so see, derivative is a type of instrument, okay? So I'll just give you an idea. So if we go back to uh, derivatives, these are also, see, derivatives are types of instruments. So you have to understand this, any kind of transaction, you have to understand the difference between a transaction and an instrument, okay? So transaction is a contract to exchange, in a financial market, usually a transaction is a contract to exchange assets. And one of those assets may be a derivative contract, okay? So in this framework, as you can see, we have 4 types of derivatives: futures, forwards, swaps, and options. Okay. Now, so you have to understand the distinction between a transaction and a derivative. A transaction and an instrument. A derivative is a type of instrument. Okay. These are your instruments. Okay. These two are not derivatives: cash and spot. Okay. Cash, you can also have Tom. Cash, Tom. Tom is for value tomorrow. These are not derivatives. These two. Okay. But futures, forwards, swaps, and options, these are all referred to as derivatives. These are types of instruments. So I can have a transaction. So the example I gave just now, where I'm selling a plot of land to Rajat 9 months forward, settlement date is 9 months from today, but we agree on the terms of the contract today. So transaction date is today, settlement date is 9 months from today. Now that is a forward contract involving. So that transaction will appear here. Okay, this will be at the intersection of forwards, the column for forwards, and the row for real estate. So if you see here, I can't. I will have to just make it a little smaller so that you can see everything here. So this is how you look at it. Yeah, this is forward contract and in real estate, the example I gave you. Now, forwards are also derivative contracts. Okay. So to answer Sachin's question, what he's asking is what is the difference between a derivative contract and this? Okay. So a derivative is actually an instrument, and a contract is a transaction where you enter into a contract to buy or sell. So you can enter into a contract to buy or sell derivative instruments also. And you can also enter into a contract to buy or sell things which are not derivative instruments, like spot transactions, like all the equity trading that you're going to be doing in your IPM project. All of them relate to spot transactions. These are what you're trading in your TWS account. Those are actually all spot equities. When Vipul is trading on the NSE, what he's trading, unless he's trading options, generally when you're trading the stock, you are trading most stock exchanges around the world. The instrument type that you are trading is spot. Now, spot may be T+2 or spot may be T+3 depending on the jurisdiction. Okay, T+2 means if you do a transaction, T is the transaction date and T+2 is the settlement date. So you agree the contract today, and the settlement, that is the exchange of assets. Remember, what is the contract? What is the transaction? It's a contract to exchange assets. Now, if you entered into a contract to exchange assets, then you have to fulfill that contract. So you have to deliver those assets and you have to take delivery of the one that you bought. So that happens on the settlement date. All right. So this is basically it. So the answer to Sachin's question is that there is a distinction between instruments and instruments and transactions. Okay. Transactions are contracts. Contract may involve instruments of any type, and some of those instruments are not derivatives, and some of those instruments are derivatives. So Sachin, does that answer your question?
Yes, sir. Yes, sir.
Okay. So we'll go back to our discussion. So what we will do is we will just put in a note here, since we had this discussion about just put in difference between transactions and instruments, just to clarify, so that other people can also be clear about, maybe others also had that doubt in their mind. So difference between transactions and instruments. Okay, a transaction can involve any type of instrument. A transaction, and this transaction here, you have to read it as transaction in a financial market is a contract to exchange assets. Okay, so I'm not giving the full definition here, but a transaction can involve or can relate to, okay, involve or relate to any type of instrument, okay, instrument that is a derivative instrument or example spot instruments which are not derivatives. Okay, so that's the explanation, the full explanation for Sachin's question. Example spot instruments which are not derivatives. Okay, so that's basically the explanation. So here what we can do is we can put a link to this particular thing, which is I think already in your folder. So it will basically straight away take you to instruments. If we put a hyperlink in there, so it will take you directly into that spreadsheet. Okay, so that's the response to that. So let's move this here now. Okay, let's continue with our discussion, which on DP4. So here what we were saying is that we are not, we don't have to necessarily own something before we sell it, as long as we can find some way to deliver the asset on the settlement date. If I've sold you FCX, I need not have FCX, but before the settlement date, I should find some way to get hold of some shares of FCX so that I can fulfill my obligations under the contract in which I've agreed to sell it. Okay, so that's what short selling is. You sell that which you don't own by borrowing the asset and then selling it. Okay, or selling basically borrowing the asset to fulfill your obligation under the contract in which you have sold it. So this is how it works. So I've given you some little bit of explanation on link to short selling. So you can, in this particular project, you can do short selling, okay? And you can watch this video of Interactive Brokers and understand. So this is one of the learnings that you will have in this project. You can figure it out for yourself. If you have any questions, you can ask me. But it's nothing but you enter into, first you find out whether this will show you that IB will show you whether this stock is shortable, if there is any, how many shares are available for shorting, how many shares can be borrowed, what is the cost of borrowing, etc. And then only then can you sell it. Okay, so if it's available for borrowing, only then can you sell it. So this IB will show you. You can read the video and understand. But the main concept here is that because the layman's concept is that you can only sell what you have. But that's not true. In financial markets, you can sell things you don't have, as long as you can find some way to borrow the asset and deliver it against to fulfill your obligation under the contract of sale. Right. So the other point I put in here is that short selling is not confined to stocks. If you look at, if you go to any asset class, you can do short selling in currencies. You can do short selling in even in commodities. It's a little difficult because they're hard to source, but you can do it. And you can do it in equities, obviously. You can borrow it. You can even do it in bonds. It's very common in the cash bond market. Okay, short selling is very common, and you guys are all familiar with the repo rate. Okay, and so this transaction, we will discuss the repo transaction later on. You can do some readings on that if you want under the RBI. Go to the RBI website, etc. But what you should understand is that short selling, the learning that we are sort of imbibing at this point is that not only can you short sell, which is sell things that you don't own. But you can do that pretty much in every asset class. You are not confined to equities. Although we first encounter the term in equities, but you can do this kind of short selling, that is basically selling the asset which you don't own. You can do it also in the bond market, and when you do it in our currencies like commodities, and when you do it in the bond market, this very well-known repo transaction, the bond repo market, is a very big market in the developed countries, in the US, very, very big market. So this, one of the things this market allows is, it allows you to borrow the bond and short sell it. Okay, so one of the functions of the repo market, that is when the seller will be doing a reverse repo and the buyer is doing a repo. So remember these two terms, reverse repo and repo. This is actually the same transaction, but looked at from two different types, two different perspectives. Okay, so if I'm selling my house to Harsh, then I am the seller. For me, it's a sale. But Harsh is the buyer, and for Harsh, it's a buy, it's a purchase, and it's, for me, it's a sale. So that you don't have two transactions, only one transaction. But depending on whose perspective you are adopting, you will call it a sale or a purchase. Okay, so the repo and reverse repo is the same kind of thing. When you look at it from the point of view of the person who is selling the bond, okay, this seller doesn't refer to the terms of the repo, it refers to the background, which is whether you're a seller of the bond or not. Okay, it refers to this part here, the guy who's borrowing the bond and short selling it. So understand at least this much right now, that the repo market, the bond repo market, one of the functions is to allow people to borrow bonds and short sell them without having the bond. And another thing you should understand, repo, reverse repo, same transaction. Like somebody selling a house to someone else. For one guy, it's a purchase. For the other guy, it's a sale. Okay, so reverse repo is the same kind, one transaction only, looked at from two different points of view. Okay, so long discussion, but hopefully we are making progress. We are learning something. That is the main thing, that every session we must make some progress. You don't have to make huge progress. We have to understand everything that we are studying. And so we just have to make good progress in every session. These are all important learnings. So we will move on now to this we have already discussed. Okay, so what we call FA, fundamental analysis, this is basically what I have called FBVs, forecast-based valuation. Now, understand why we are calling it forecast-based valuation. Yeah. So all this stuff is listed under FPV. Now, you did all this stuff in your first year classes. Project NPV, stocks, bond valuation. Okay, and I've given you the general formula, which is the same for all of these. And that can be used to value any asset. Now, why is it called forecast-based valuation? Because if you remember, if you go back to your, no, this is a sheet, this is a new sheet that I put in there because you need to understand this. Yeah, okay, we'll come to this later, but let me go back to the calc file. Okay, so we are here in this calc file. Yeah, why is it called forecast-based valuation? If we put a, because if we basically what we do is forecast, maybe we should put it today's date.
Sir, maybe because we are forecasting for the future investment of the project.
Yeah, so basically I'll just put in today's date here, one second. Yeah, so Vipul is correct. So what he's saying is, what do you see if you look at the fair value of a project, okay? Fair value of a project when you're doing it, how do you get it? You basically forecast the year one. So if you have, let's say, year one, then you have, we'll just do a few years so that you don't waste our time. Say, let's say 3 years, okay? And then you can have your terminal value also in the third year. So let's say we make some forecasts, okay? First year from, at the end of 1 year from now, we will earn, say, let's say maybe $110 million. Then at the end of the second year, we will earn, say, 170 million. And the end of the third year, we will earn 190 million. And then we will have a salvage value for the project of, let's say, 50 million. Okay? So this is how we do. Now remember, these are just projections, okay? These are basically forecasts. So that's why we call it forecast-based valuation. This doesn't mean anything. I can give the same background information on the project to 38 to 37 students, and I could receive 38 different forecasts, sets of cash flows. Everybody's forecast is different because everybody has a different assessment of the future. So that's why I'm calling it forecast-based. So you get these cash flows, and then you discount them. You find out the discount rate. Whatever the discount rate is, you can set it maybe 15%. All right. So this is either your WACC or your cost of, let's say we call it, this is the WACC figure. And then you use that. And then here what you do is you put 1 plus 1.15. This you divide by 1.15. This you divide by 1.15 to the power 2. Then this you divide by 1.15 to the power 3. And then you get the three PV figures. And then you add them up, and then you get the fair value of the project. Okay, everyone is following so far what we are doing here. I'm not going through those steps to save time, but this is what you do. So this is why I'm saying that although NPV is technically not the fair value, because NPV is the fair value adjusted by the from the fair value, you subtract the cost of the project. Okay, so if you look at your NPV equation, project NPV equation, this is what it has. It contains all these cash flows, okay, and then it also contains that minus C0 term, which is the cost of the project. So you add up the PVs of these project cash flows, and then from there which is basically, what is that? This set of terms, if you leave out the C0 from the NPV equation, this is basically the fair value of the project, because this is telling you giving you the answer to this question of what is the true value of this project, and the answer is the true value of the project is whatever returns the project can deliver for us, the present value of all the future returns. That's what it is. Okay, so when you do this part, that's your fair value component of the project. So your NPV basically is nothing but NPV is basically fair value of project minus cost of project. That's basically what it is. All right. So if you see the cost of the project, it's basically like the minus cost, because the cost of the project is the cost of the project for the person for the company who is doing the project, who's going to basically put up the whose project it's going to be, right? So you can think of the cost of the project as the market price of the project. So let's say if Delhi Metro is extending the line to some out further suburb of Delhi, then L&T gives an estimate of say $300 million. Now for Delhi Metro, when they're doing the NPV analysis, they will put in the $300 million as the cost of the project. Okay, and then they will do the fair value of the project based on the returns they're expecting. So this is basically how you have to understand this concept of fair value in the context of something you're already familiar with, which is NPV. Okay, and you can see it will fit. I'll come to this discussion later. I don't want to waste time on it right now, but you will see that this whole thing, you can do this experiment for yourself. It will fit into this project. When do you reject the NPV? When the NPV is negative. When you reject the project, the NPV is negative. NPV is negative means fair value is lower than cost of project. Okay, cost of project is like the market price of the project, because the L&T is charging me $300 million, to extend the line, extend the metro line. Then that's basically for me the cost of buying that extended metro line in the market. That's what it basically is costing me to buy that. So it's like the market price. So you reject the project, which means it's like selling the project, or you don't buy the project when the fair value is less than the market price. Okay. And when do you accept the project? When the NPV is positive. So which means the fair value must be higher than the cost of the project, which is the market price, right? Essentially, let me write this here also. Like a market price. Okay, the English is not perfect here, but we're just trying to convey the meaning.
Sir, can we use forecasted value instead of fair value?
Can we use forecasted value?
Yes, sir. Sir, because in NPV, sir, we are making forecasted predictions before, and then we calculate our return
Yeah.
of the
I,
project.
I would say don't use the word forecasted value in general discussion, because I think the right way to do it is to say that, let's put it this way, that value means fair value. We can discuss it here. Um, let's put it here that before we go to this, let's say um, all, not all, okay, most common fair value models. So the jargon that you need to learn is this. Okay, this is the industry jargon that you should learn. This is the correct theoretical jargon that you need to learn, which is this. So that's why I would say to Vipul and everybody else, don't use the term forecasted value rather than fair value, because this fair value model has a particular theoretical meaning and it has a particular understanding in the industry. Okay, so most common fair value models. What are fair value models? Okay, NPV, okay, IRR, okay, these are also all basically fair value type models. Then Gordon growth model. I'm just writing GGM, okay? You guys should know Gordon growth model, okay? Or any earnings discount model for valuing stocks, etc. Okay? These are all fair value models. You may not have heard this term before, but we are learning it now. This is the technical jargon that you should learn, okay? These are all fair value models, because what are they doing? What is the Gordon, this should be GGM. Yeah. What is the Gordon growth model doing? It is basically forecasting, let's say these are dividends. It is saying that year one, I will earn this dividend, year two, I'll earn this dividend, year three, I'll earn this dividend, and then this will be the terminal value. What is salvage value in projects? In the case of stock valuation models, this is the what we call the terminal value of the stock. And the stock will be worth $50 in year three, and I will sell it at $50. And then I'll get 190 as dividend or whatever. Okay, so this is so what is the GGM Gordon growth model doing? It is forecasting the dividends and coming out discounting the future dividends at the appropriate discount rate. And in this case, this should be the cost of equity, because it's accruing dividends are accruing to shareholders only. And you come up with this. So basically, these are all fair value models. It is telling you what is the fair value of the stock. And so what you should say in response to Vipul's question, that most common fair value models are, now notice why I said most common fair value. Earlier I was writing all, then I cut out the all, and I hedged myself and I put this. Why did I do that? I'll explain to you, because what I'm writing here does not apply to the AFV models. Whatever I'm going to write now, that does not apply to AFV models. And AFV models are also fair value models. Okay, they are also part of this approach. But because the statements I'm going to make now, they do not apply to fair value to AFV models, because these are not based on forecasts. Okay, so that's why I changed my language. Instead of writing all, I said most common fair value models. So if somebody says, what about AFV models? I'll say that, hey, I never said all fair value models. I said most common fair value models. Are what people should be actually saying, or what everybody else should actually be saying in response to, in the context of the first question, is are examples of forecast based valuation. Why do I say forecast based valuation? And then we will distinguish it, because there are two broad, under this, whatever you have is all based on fair value models. Because what you do, you take any fair value model that you want, NPV, Gordon growth model, enterprise value model, this and that. And these are all fair value models. You take any fair value model, use that to calculate the fair value according to you. Remember, it's always according to you. When you are in this branch, it's only according to you. It doesn't really have any great sanctity because it's just your view. And then you take the fair value estimate from the fair value model based on your forecasts, and then you compare the fair value to the market price, and then you take the decisions which we discussed earlier. Okay. The distinction we are going to make later on when you understand AFV is that AFVs are not AFV models like foreign exchange forward pricing, foreign exchange cross rate pricing. These are not based on forecasts. These are based on actual market prices. So these cannot be called forecast-based valuation models. Okay, so although these are also fair value models, these are not forecast-based valuation. That's why I made this distinction. Okay, so this is like boys and girls. Boys are not girls, and girls are not boys. Okay, so remember, any taxonomy, categories have to be mutually exclusive. So if I do this, then this has to be different from this in some fundamental way. That's what it is. So long answer to Vipul's question. This is what he should be saying. Instead of saying forecast models, etc., forecast models, you can say the correct term to use is actually fair value models. And you should understand that most of the common earnings discount model, or a very common model which you see in M&A work, enterprise value models, okay, or enterprise value earnings discount models, or earnings discount model means nothing but, instead of same as GGM, instead of dividends you replace it with earnings. Okay, basic structure is the same. Our enterprise value models for valuing stocks. Okay, these are all models for valuing stocks. GGM, earnings discount models, or enterprise value model. This stuff is very common in M&A. Enterprise value means instead of valuing the stock, you value the whole company, and then you deduct the market value of the debt, because some of the assets, you value all the assets of the company, and then you deduct the debt, you subtract the market value of the debt. Sometimes you take out the cash value as well, but that's not so important. But the main idea is these are value models for valuing stocks, basically. Okay, for valuing means fair valuing stocks. Here, finding the fair value of stocks. These are all examples of forecast-based valuation. This is what you say. This is what you should be saying. And why, if somebody asks you, why do you make this kind of statement? Because all of these models, what do they have in common? The same thing here. They all go through this process, whether it's project NPV, Gordon growth model, they all involve the analyst, involve the analyst making forecasts. Understand this is just a forecast. Okay, it's like me saying I will live to the age of 95. I mean, it's just a statement. It doesn't really have any great value. Would anybody rely on it? Probably not, because you don't know. I mean, there's no guarantee that will happen, right? So it's just a forecast. So that's why we call it forecast-based valuation, because these are all based on the same. They all have one thing in common. They're all based on forecasts of future returns, which are not guaranteed to, fructify. This may happen or it may not happen. So that's what we mean by this statement. So now, Vipul, are you clear about how we should discuss it?
Yes, sir.
Okay. So always use this term fair value models, because this is people in the industry will understand it, and this is also theoretically correct. But you should understand that other than AFV models, the rest of the fair value models are based on forecasts. So you can say these are examples of forecast-based valuation. All right. Okay, so moving on, we can put this in a little bit of italics. Okay, once again, reminding you all, everybody, if there's any part of the note that you don't understand, you have to keep reading the note. You have to do a lot of work outside the class on your own. Okay, a lot of reading of what I've given you. Okay, don't worry about the textbook at this point. You just follow the readings I'm giving you. But you have to read those notes and make sure you understand them. And if you don't understand, then you ask me. Okay, and then I'll clarify it. Okay, so we have already discussed these things. Now we are here. Okay, so now we are going to move further on this and look at this, go back to this DP4 and how we are going to use it. Okay, So we are trying to help you to solve this decision problem that you have in your project. We have already told you how to solve this, but in solving this, we needed to assume that we had a decision for this. Okay, so we assume some decision for this. We have already had some discussion about entry price also, but you'll be facing all this in the project. These two will come to later. Okay. Initially, I have told you for the exit price with loss, I have told you to just use highs and lows. Okay. So if you are buying FCX, uh, let's just use, if you're buying FCX, then just use a stop over here. Let's assume that as far as number 5 is concerned, entry price, you can use a limit order, but I'm just, for the sake of simplicity, I'm assuming everybody does all transactions at market prices. So you buy at market. And how do you solve this? I have given you a guidance. I'll explain the logic later. But as far as this is concerned, this is more important than this. Okay, you can operate without 6.1, but you cannot operate without 6.2. Okay, so this is more important. And so for this, I have suggested you use this. If you're going long at the market here and you're going long this stop, put the stop just below this. Find out what it is. Find out what the low is. Read from the chart. Use the cursor. And just 1 cent below the curve. So here the low is 1422. Okay, the low is 1422 on 21st August at 9:30. So then I put it as 1421. I put my stop in the TWS. I put a stop order. Okay, when you look at the order type, initially it will give you market order, but you can enter, you can modify the order type and make it a stop order. And then you put the stop trigger level at 1421. Okay, you have the notes for DP5. You can read the order types under DP5. Okay. Under entry price, you will already have a discussion of the basic order type. You have to do all this reading. Okay, all this, lot of it. Yeah. Somebody else's audio is somebody's audio is not mute actually. So there's noise coming from there. Okay. All right. Yeah. Just make sure you have your audio on mute, everybody. Okay. All right. Okay. So let me just get on with the. Yeah, so let me just find here. So I'm just giving you a brief recap before we continue with this. So it's a little bit haphazard, but I'm just making sure you have an idea about how it is to be done. So for 6.2, which is a very important decision, okay, to take, where should I put my stop? Just do this. If you are going long, find out the next, find out a nearby low, okay, and put it underneath that. So it's 1422. So you put a stop trigger level of 14.21. Read about stop trigger levels under DP5, where you have discussed the stop order level with different types of orders. If you are going long, if you're going short, this is if you're going long. Okay. So let me just, I'll just take some other stock in case, let's take this one stock which is in a lot of trouble. Okay. So in this case, let's say General Electric, if we go long, if we go short, okay, if I'm going short at market, then on this time frame, the easiest low, the easiest high that I can see is this one. Okay, I'll explain the logic later, but in this case, so you can understand visually what I'm saying. I think everybody understands visually what I'm saying. If you're going short at this time, at this price, market price, or even at a limit price, even if you want to place a limit order to go short at 10, you place the stop over here. Okay, so for that, I mean, basically, if you follow this this guidance, it helps you to, later on we'll give you more detailed logic for this, but it will help you to solve this problem because you need to solve it on a daily basis. Now, coming back to this, the buy-sell bias. Okay. Now, let's go back to this. So what are we doing? Right. So we have discussed it. So what we started, the discussion we started our discussion with this broad differentiation that there are two approaches to solving this. One approach is this, the value versus price comparison approach, or we'll just call it value versus price approach, okay, for short. this is too long expression to keep repeating. So value versus price, when I say that, actually what I mean is an entire thing. And the other approach is value agnostic, which is basically price-based analysis, purely price-based. We don't care about value. In this branch of the tree, we only look at price. We are not interested in value. I don't really care what fair value is. I don't know what it is, and I don't care. I just look at the price. So that is basically what we call TA, or technical analysis. So we'll come to that. Now, briefly, just want to explain a little bit further about FA. So what you have done here, all this stuff, then when you are applying these kind of models, the fair value models, when you're applying, let's say, this is your Gordon growth model. Let's say this is these are your dividend projections. So the kind of analysis that you went through to arrive at your dividend projections, okay, and also your terminal value projection here. This is the terminal value, $50. And when you go through all this, how did you arrive at these numbers? Okay, the analysis that you went through, that is basically called fundamental analysis. So fundamental analysis essentially is about, just give you some idea here. You'll find it in your notes, in the notes that I've given you essentially, that we look at essentially this, let's put a small bit here when we're talking about FA versus TA. More on. So we'll have a little bit of a small introduction. You'll see other material also. And so broadly, to summarize, essentially, FA, okay, what is FA? FA is fundamental analysis, okay. We have a big sheet also in your just copy from there. This sheet is already in your folder, okay, so you'll have links to this. You have the link to the spreadsheet here. Okay, so FA fundamental analysis. Essentially, I'll just give you a broad idea, and then you'll find more detailed notes. This is basically macro and micro. Macro plus micro. So let's say micro is sectoral. Micro actually includes the idea of micro includes the idea of firm level data also. You did your microeconomics, all the marginal cost and all that. So macro plus microeconomic analysis, that's basically it, okay? Macro plus microeconomic plus also political analysis, okay? Everything is included in FA. So what will happen in the US if Trump wins the election versus if Biden wins? Then Trump will cut taxes further, but Biden will raise taxes. So you do some political analysis also, then Biden may actually put in more regulations. Trump is going to cut regulations. So the political analysis that you do, that is actually finally not as an end in itself, but basically what does the political development mean for the impact on the macro and micro economy? That's basically is, yes, Gagan, what is the question?
So like Shinzo Abe, president of Prime Minister of Japan, stepped down from the position. Like he's saying that due to illness, I will not further continue.
Okay, yeah.
So we have seen that the Japanese stock market plunged with the 1.5%, and Beijing stock market rise by around 2%.
Okay.
Because he's prime minister since 2012, and now he's stepping down due to his illness.
Okay.
So at there is a like economic like plunge, that how they can handle economy, like new policy, and who will be the prime minister, like.
Yeah. So you're correct. What you're looking at is correct. The example that you gave is also correct. So you look at political, as Gagan has explained, the reason we track the political factors is not that not because we are in particular interested in politics, but because political developments can have an impact on the macro and microeconomic data or the developments, okay? And that eventually what it does is it affects our estimates, okay? So if there is a massive, like a COVID-19 kind of pandemic, And then we were actually doing the fair value estimate for a hotel company. Let's say you have a company like Starwood Hotels, which is a very big hotel company, or Hyatt Hotels. So these companies now, obviously, the hotel business is going to be very badly hit. Now, political, of course, this is not, COVID is not a political development, although you could say, that, well, but it's basically any kind of development that we follow, macroeconomic, political, okay, plus weather, okay. Any kind of weather, like there's a massive hurricane hitting the Texas and Louisiana coast. So if you were trading oil, now in your IFM project, you'll be trading oil. So one of the factors you will have to consider, actually this is hitting right now. I think yesterday it was, or maybe it's making landfall today. There's a massive hurricane, category 4 hurricane hitting, like this Amphan kind of hurricane hitting Texas and Louisiana, where a lot of oil is stored. So if you are doing, to give you an idea about fundamental analysis, if you're an oil analyst, okay, you will have to consider what is the impact on the oil storage facilities, the logistics. Because last time there was a hurricane, they could not move the oil for a long time. What impact does it have on the supply chain, and how will it affect the price of oil, the supply demand disruption, and then what happens to the price of oil? So all this falls under FA. Okay, is everyone clear? Broadly, this is what FA is. So I've given you some links. If you see in your notes, in the master list, I've given some links. So when you do, these are links for your financials. We can make this a little bigger. All right. So I've given you some links to Market Watch financials. Is this? Yeah. And then I've given you Yahoo Finance also. So when you do all this kind of analysis, so you'll see some financial. We don't have to wait for it to load. But the point is that when you're doing stuff like ratio analysis, you're doing a sales trend analysis, then trends and cost trends and all that. So I've given you the links. You can just replace the ticker. You can, if you are doing it now for say Dow, then you just enter Dow over here and it will change. Okay. So when you do all this ratio analysis, okay, all the stuff that you do, this is all part of FA. Okay, it all falls under FA. This is what FA is all about. Okay, so please make sure, guys. Once again, reminding you, very important. All of you have signed up to be finance students. Okay, you better make sure that your ratio analysis, you should be able to do it with one hand tied behind your back. Okay, like you do WhatsApp. So you should have WhatsApp level of expertise in all of this ratio analysis. If I ask you activity ratios, DuPont ratio analysis, breakdown ROE into component parts, you should be absolutely fluid in this. Okay, please make sure this is your job. Remember, we are out of that school mode of learning where you memorize something and vomit in the newspaper. We are now in the PG mode. You need to acquire skills. Your teacher is like a coach. The coach will tell you, you need to work on your backhand. Now you have to go on your own and stand on the court and work on your backhand for 4 hours. The coach will not be there all the time with you. The coach's job is to guide you and tell you what you need to work on. Okay. So this is your business, your responsibility to make sure that when it comes to ratio analysis, financial statement analysis, you can do it with one hand tied behind your back. You should be so fluid in it. And and all comes from practice. Like one of your seniors, Dina, who has joined Care Ratings, she was asking me that even when she was joining that, she forgets. And so I told her, it's all practice. Everything is practice. You keep on practicing until you can do it in your sleep. Okay. So it's your responsibility. Make sure you do all this. Okay. You make yourself skilled through your own practice. Okay. So all this is fundamentals. I've given you the links. You can do this. Okay. So part of how we are coming back to our project, you are going to face this decision problem. Should I have a buying bias or selling bias? There are two broad approaches. We haven't come to this TA as yet, but we are discussing FA. So to the extent that you want to apply this paradigm, value versus price, you can practice this kind of FA analysis and train yourself. But even otherwise, this is as I've already told you, ratio analysis. You have to become a master of ratio analysis. And later on, when DG Sir does his course with you, corporate finance modeling, those concepts will be very useful. If you work on it from right now, much of it you have done in your first year already. If you work on it, it will also be very useful. It will make your job easier during DG Sir's course, and then you can just focus on the Excel part of it. Okay, he will help you with spreadsheet modeling, but the concepts have to come from your own reading. So make sure you do that. And this also ties into your FA. You understand that all this is FA because it all goes into your, all this analysis you do. What does it do? It basically helps you to come up with these numbers. And at the end of the day, understand also one of the problems of these models. Why do so many people lose money, even trading on fundamentals? Because there is no way for you, no matter how sophisticated your modeling, you can do Monte Carlo analysis and all kinds of stuff, right? You can do all kinds of stuff, but this uncertainty about these numbers, okay? These uncertainty that remains that attaches to future projections of economic, phenomena, okay, is you will never be able to solve it. You have to accept that. This is not a science. This is not a science like physics, where we can design a Mars rover and it goes smoothly and goes and lands on Mars, collects the data, comes back. You saw those two guys going with Elon Musk's company to space, landing in the ocean. Okay, everything perfect because it's perfect. Science is perfect, but this is not science. Finance is not science. Even though the people who are trying to sell you courses based on financial modeling, obviously you have to understand the politics of this. Okay, if I'm selling you courses if I'm selling you a course on high-tech financial modeling, okay, using whatever Excel and don't Excel and everything else, you think I'm going to tell you that this model is basically, all this stuff is basically useless because the future cannot be predicted? You understand what I'm saying? I'm not going to tell you all that because I want you to be, completely mesmerized. High-tech financial modeling, and you will pay 50,000 rupees to do that course. So nobody will tell you, nobody who's selling a course is going to tell you all this, but I am telling you this most important lesson because my job as a coach is to protect my students in the future when they go into the real world. And I'm just telling you, do not fall in love with your projections and your models because basically they don't mean anything, okay? So as I call them a bunch of assumptions because there is no way. This is basically, what these projections are like, as I gave you the example many times. This is like me making a statement, I'm going to live till the age of 95. What does it mean? I mean, who would rely on that statement? Because everybody knows that there's no basis for me to make that statement. I may or I may not, right? So the basic uncertainty that attaches to life and the future attaches to all economic projections. So never forget that because nobody else will tell you this. The textbooks will not tell you this because the textbooks are written by academics. They have never traded any share in their life. So they don't know what the real world is. Basically, they don't have a very good idea about the real world. And the people who are selling you fancy courses on financial modeling will not tell you because it's not in their interest. Okay? If I'm a real estate broker and I'm showing you a house and I'm going to earn a commission if you buy the house, if the house is haunted, do you think I'm going to tell you that the house is haunted? I'm not going to tell you because then you may not buy the house. So understand the politics of all this because the real world, I'm just teaching you about how the real world works. So what you have to do now, does that mean that you should not study these things? No. What it means is the point of everything that I'm saying is that you have to understand the theory behind all this. Okay, so I'm going to help you understand that, and I've already given you a general theory, general model, and all that. I've shown you how this is all basically the same model, Forecast the cash flows, forecast the returns, discount the returns, add up the PVs. That's it. Okay. But what I'm telling you here, very important. I may not repeat this in the future, but very, very important. Do not fall in love with these models. These are just a bunch of numbers that you threw out. It's just like me saying I will live to the age of 95. Only a fool would rely on it. Okay? So understand that these are very, very fallible. So be very careful about how you manage your risk. And that's why you will see later on, we will discuss one point with you. This is the most important decision of all. Exit price with loss. Later on, we'll have the discussion about trading systems and all that. But I'm telling you right now, there has actually been research done. You could actually solve this number 4 by tossing a coin. It won't make a difference. Okay, you could actually solve it by tossing a coin. Okay, nobody will do it because they want to work on it. But what really matters in survival is this, and of course this also. But basically, you ensure that you don't lose more than. So basically, what matters in what really matters for survival is this thing. You make sure you do not lose more than this. This is what will protect you. Okay, this is what will protect you in the future. This will ensure your survival. So these are your discussions. So we have pretty much come to the end of the class today. So I'll kind of let you go. And but so we will continue further with DP4. But you have some idea of FA. And then what you should do is you can start reading about these notes. Then we will go on to the discussion of TA. Basically, TA, all we are saying is, I don't care what GE does. I don't care if they make turbines or what. I'm really not interested. Is GE an American company? I don't really care. All I care is the price of GE. I have my usual framework. Okay. What is my framework that we decided in response to Sachin's question? We said time frame 1 year and 3 months for our project. So everybody will have some system of operating. Okay. So 1 year, I look at the 1 year GE trend, it's down. I look at the 3-month GE trend, also down. Immediately, I go short. I solve the DP5 by trading at market all the time. I go short and I use the rule given by my teacher, which is put the stop here. The last high from which, because I'm going short, the last high from which the new low was made. The trend is down, 3-month trend is down, 1 year trend is down. So you see how quickly we solve the whole set of problems. I go short at market. I see that 1 year trend is down, 3-month trend is down. Both are in the same direction. Immediately my decision is sell, and I sell at market. That's for the sake of simplicity. And I put the stop here. So already, I'm just taking 1 minute extra. Already you see how quickly we have solved. We solved this problem, exit with loss. We solved the buy sell DP4. Okay. We solved this problem, DP5. Okay. 6.1 is not so important. Okay. Let's forget about 6.1 for now. I solved this. I solved this. I solved this. Okay. All very, very quickly using TA. I don't even know what GE does. I don't know what business they're in. I don't know who the CEO is. Okay, I have not read any of their annual reports. I haven't seen any of their financial statements. I don't care about all that because I believe that all that information is already in the price. I solved everything. The last problem is buy sell position size. Okay, so I go back to my calculations. I see my investable capital. This capital I take as 600,000. I projected this many. Maximum risk for trade is this 4286. So if my entry price is 649 and my exit is going to be 7.23, exit with loss. So 649 to 7.23 loss per share projection, and divide, where is that? Yeah. Divide 4286, also add in the commission cost, divide 4286 by loss per share, and I've solved. Now you see I solved all my problems. Okay. 7 solved, 6.2 done. We don't need to worry about 6.1. 4, 5, 6.2, 7, all done. You see how quickly it's done just by using TA. Okay. So that's the beauty of TA. Very simple. I've taken 2 minutes extra. You can think about this and you can move on. And then we'll meet again in the next class. Please make sure you do your readings, guys. You have to keep on reading. You cannot rely on the old school style of reading. I'm not going to spoon feed you. I'm here as a coach to answer your questions and to give you guidance. and you have to do most of the work by reading. Okay, and my job is to explain everything to you and to give you clear notes which you can understand. And if you don't understand, you inform me, and then I will clear up the notes further. Okay, all right, so you can leave, guys. All right, if you have any questions, anybody has a question, you can ask me. Otherwise, the rest of the class is dismissed. Yes, I hope I was audible. Yeah.
Yes, sir.
Yes, sir, you are.
I think the most important part of the class, right? Class is dismissed. Okay. All right. Yes. Anybody?
Okay, sir. Thank you so much. Thank you.
Welcome. Any questions? Anybody? Okay. So no questions. So we'll finish it off here. And then if you have any questions, we can, I will also want to arrange an extra class sometime. I'll get in touch with your CRs for that. Okay. All right, guys. See you then. See you in the next class.